Greetings, this is Chapter 17, Video 3. Let's launch. So today's learning objectives are going to be calculate the current and deferred tax expense or benefit components of a company's income tax provision. So determining whether a valuation allowance is needed or not. So you're going to need to do that for it, and if it fits under these circumstances, which is a valuation allowance is required, is more likely than not that all or some of the DTA will not realize in the future. And so ASC 740 actually requires 4 sources of potential future taxable income, 2 of which are objective and 2 of which are subjective. So the objective sources, that's going to be where you have future reversals of existing taxable differences. So if the reversing of the taxable difference provides sufficient future taxable income to absorb the reversing deductible temporary differences, the company does not record a valuation allowance against the deferred tax asset. Taxable income in prior carryback years, the company does not record a valuation allowance if the tax benefits from the realization of a deferred tax asset can be carried back to a prior year or has sufficient taxable income to absorb the realized benefits. All right. And I know I'm kind of flying through this, but I mean, this is kind of what it is. I mean, there's not really much more to add to all of this stuff until we get to the subjective area. So, basically expected future taxable income exclusive of reversing temporary differences cash forwards. So the company might support its predictions of future taxable income with evidence of existing contracts or sales backlog that will produce enough taxable income to realize the deferred tax asset when it reverses. So basically what this is saying is that, hey, I got to the end of the year and I have a bunch of contracts that I'm working on. You know, it's kind of like Han Solo, from Star Wars. I have the money, but I don't have it with me, And if you're not a Star Wars fan, well, I'm sorry. Anyways, Star Wars, Star Trek fans, I noticed that most of my students aren't Star Trek fans, which is starting to make me wonder about our next generation. But anyways, so the company, again, if I notice that there's a whole lot of, I've got contracts that are coming up and I'm saying, hey, look, I know that I'm going to realize this stuff. I know I've got sort of, I've got a DTA that's going to come up maybe I've got an NOL. Say I've got, $1 million in NOLs, but but part of the reason why I've got the NOLs is because there's kind of a mismatch between expenses and the actual realization of the sales contract. So this happens a lot in government accounting. So what happens is that sometimes you'll go out and you'll perform the work and the work will be complete. So but perhaps the work is not fully complete until the following calendar year. So for example, January or February. Now, depending on how they do it if they're doing a long-term contract method, this will alleviate itself very easily. So for example, and I used to do some construction accounting at one of my firms that I worked at. I was actually a construction accountant. And, so if you do long-term contract methods, so say, for example, I'm working on a government contract and it's a 4-year contract, and we're going to record this under the long-term contract method as required under the financial accounting and, of course, in the tax accounting. What's going to happen is that I've got 2 ways that I can do that. I can do percentage of completion, or I can do, completed contract method. Now, under GAAP, you do percentage of completion. So it's a PCM. You're going to do PCM, percentage of completion method. And then if you have, under tax, you can make an estimate. You can actually make an election that says, look, I'm not going to record this income until I have the contract completed. So 4-year contract, I may not complete that contract until 4 years later, but I have all these expenses that are coming up that I have to pay. I mean, I'm still paying it, but maybe I'm not receiving any money on it until later on. And as a result of which, until the bits of the contract that are complete that allow me to recognize that income, I'm not going to have that. So maybe, and I said a 4-year method, but say, for example, we're coming to the end of a 2-year contract and that contract ends next February, and I'm going to get a whole bunch of money in February in order to do that. I can go back to them and I can say, look, there's no valuation allowance because we're going to recognize this. And if it's in February, even better, because I don't file the tax return until April. And if I'm not filing the tax return until April, I'll know the money's going to be here. I know the money's here because I see it coming in. And so as a result of which, I don't have to worry about whether I need a valuation allowance or not. And so that's something that you can use, and that's kind of what they're getting at here. Tax planning strategy. So you can include, sales leaseback assets, changing inventory, accounting methods, blah, blah. I'm not going to go over all this sort of stuff. These are just some tax planning strategies that you can do in terms of like valuations and whether it, allows and certain things of that nature. Again, I'm not going to talk too much to this. Okay. So in this one, it says city has sufficient tax planning strategies. This is actually a cutout from the Form 10K in 2012. And it says city has sufficient tax planning strategies available to it under ASC 740 that would be implemented if necessary to prevent carry forwards from expiring. These strategies include repatriating low tax income sources, blah, 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 so on and so forth. I'll let you read that. But this is where you can use some of those tax planning strategies in the past, in the past slide that actually can be used in this slide. I mean, in the future years, if you feel like that you're going to have some NOLs that are expiring, and some of them work and some of them don't. It's going to be kind of client dependent. You're going to have, but this is where, again, guys, people pay for it. I'm going to tell you something. Tax return work is like insurance. Okay. There's certain insurance that's called what we call bread and butter insurance. And then there's certain insurance that we have that is called, the golden insurance. And, when I was looking at, prior to getting into accounting and I was leaving the military, I was actually thinking about instead of owning my own insurance company. And so I was getting, licensed in P&C insurance, and I was getting licensed in life insurance and health insurance. And the thought process that they had with that was, P&C insurance is your bread and butter. Okay, that's the stuff that you do because you have to. You have to have car insurance. You have to have home insurance. You have to have liability insurance because, a lot of places are just going to require you in order to be able to do that. Nobody requires you to have life insurance. And if you take a look at the commission schedules, usually life insurance has a better commission schedule than P&C. So if I have a P&C policy, I get 10%. If I sell a policy for $1,200, I'm going to get $120. It is what it is. That's just kind of how that works out. And so that's how P&C insurance works. Life insurance, what will end up happening is the first year I will probably get 80% of the premium. And then in the following years, 5 after that, I'll get 40% of the premium. And then after those 5 years, I get like 2% of the premium, and then it goes 2% on. So the thought process is if I go out there and I sell a whole bunch of life insurance policies my first year, and maybe I do it for the first 5 years, I will build up enough in my first few years to keep my business going. But as I build more and more clients, what will end up happening is I'll build enough of a revenue stream at the end that I don't have to work as hard. So how does that relate to this? People are going to pay for compliance because they got to have it. Okay, people have to have the compliance. So they're going to pay you a bunch of money in order to get compliance. But you want to make the big bucks, you want to make the big impact in your clients, you're going to do the type of life insurance type stuff that they may not necessarily think they need, but after we've explained it to them, they kind of go, "Oh, wow, I really do need this." And it's not because clients are dumb. It's just that clients don't know. They're ignorant. And it's our job. And I've always felt it's my job to sort of educate people, give them the knowledge they need in order to be successful. And then I don't have to be a salesperson. I'm not a salesperson. I just point out problems. Hey, you have a problem here. You have a problem here. You have a problem here. I've got a solution. You want the solution? Sure. Okay, there it is. That's not sales. Sales is basically where I lock you in a room and I tell you you're not leaving here until you buy a product. But they're going to pay for compliance because they have to, because they need the compliance. But the value that they're going to see, the things that they're going to want to come back to you for day in and day out, is when they come to you and they notice that you have answers to problems that they need to have solved. All right, so negative evidence, the valuation is needed. ASC 740 requires a company consider negative as well as positive evidence in determining whether it's more likely than not that a difference is done. The more likely than not standard was actually something that they really, really pushed onto us at KPMG. I heard that phrase more. What would happen is that when we would determine, well, do we want to take this type of a tax deduction? Is it aggressive, blah, 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 so on and so forth. Is it more likely than not that the IRS would take an issue with it? And if it does, then, we're not going to do it. I mean, that's just kind of the way it worked on the conservative side of things. And so on and so forth. To be honest, I think some of that's because there was some trouble in the past. There's an old saying that we used to say in the military, all regulations written in blood. Somebody got killed, so as a result of which we now have these regulations to follow. I think that's kind of the same way in tax. When somebody gets into trouble, the first answer that any firm's going to have is, okay, we're going to write a policy to make sure this never happens again. All right. Negative evidence includes the following. I'm not going to read them. I'll let you take a look at them and you can see how they are. All right, so that's all I got for this video. It was great to see you here again. I look forward to seeing you at the next video, and I'll see you then.